Good afternoon, everyone. I'm Inki Cho, Senior Financial Market Strategist at Exness, and this is your weekly market outlook for January 14th, 2025. The December NFP data confirmed that the U.S. job market is still strong, with job growth of 256,000, significantly exceeding Wall Street expectations of 165,000 and reaching its highest level since March. The unemployment rate decreased from 4.2% to 4.1%, alleviating economic concerns. As a result, worries about rising inflation increased, leading to diminished beliefs that the Fed would continue to cut interest rates. Strong employment generally heightens inflation concerns. The market is increasingly worried that inflation in the United States could surge to the upper 3% level. The University of Michigan's 1-year and 5-year inflation expectation figures are projected to rise to 3.3%, well above the Fed inflation target of 2%. These alarming trends clearly reflect anxiety regarding the robust tariff policy that the second Trump administration is set to implement, which will undoubtedly intensify inflationary pressures. U.S. long-term yields are soaring, driven by persistent high inflation pressures and a robust job market. The U.S. 10-year Treasury yields had surged past 4.8% at one point and is rapidly approaching the critical 5% threshold, with both the 20-year and 30-year yields exceeding 5%. This alleviated long-term yields pose a significant threat to both the bond and stock markets. It is crucial to recognize that if the 10-year yield surpasses the 5% mark, we can expect a wave of profit-taking in the stock market. The sanctions imposed by the United States on the Russian oil industry are set to significantly drive up overall prices. As these sanctions take effect, we are already witnessing a sharp increase in oil prices, heavily impacting a key source of revenue for Russia's war efforts in Ukraine. Additionally, several factors will contribute to a sustained rise in oil prices in the near term. Expectations for a robust recovery of the Chinese economy are growing, while the demand for heating oil is surging due to the current cold spell in the United States. As a result, we can confidently anticipate a substantial increase in buying power for oil prices in the immediate future. Major semiconductor stocks such as Nvidia and AMD experienced a significant decline of over 3% following leaks about impending semiconductor export control from the Biden administration. This legislation categorizes countries into three distinct tiers. Only a select group of friendly nations, including South Korea, Japan, Taiwan, and key Western allies, will have the privilege to import AI semiconductors without any restrictions. In stark contrast, approximately 20 hostile countries, including China and Russia, will face effective import bans on AI semiconductors. Following the announcement of the NFP in December, the market's focus is shifting decisively to inflation data. The release of December CPI is set for tomorrow, and most Wall Street institutions are predicting a rise in the headline CPI to 2.9%, up from 2.7% in the previous month. If the December CPI surpasses this market consensus, the Fed will likely pause its plans for the rate cuts. There is a real risk that rather than merely freezing rates, the Fed could opt to raise the rate again. This scenario will undoubtedly lead to an increase in long-term yields, which will exert downward pressure on the prices of most risky assets, including major tech stocks. Currently, the market is indicating that the probability of a rate cut in the FOMC in January stands at less than 3%. Instead, a significant emphasis is being placed on the likelihood of the Fed opting for a rate freeze, which sits at an impressive 97.3%. Should the Fed decide to maintain interest rates at the FOMC meeting in January, we can expect to see surging profit-taking demand across various asset classes that have risen in anticipation of rate cuts. Additionally, it is important to recognize that a rate freeze could once again lead to a strengthening of the dollar. This is the end of the market outlook for the 14th of January 2025. I'm Inki Cho, the Senior Financial Market Strategist at Exness.